Welcome to another episode of VantagePoint from Trivantage Capital. Trivantage Capital is one of the thought leaders in portfolio management in the Indian public markets in equities. We are a portfolio manager of choice for many professional investors. My guest today is S. Ganashyam, a close friend and an ex-colleague who also happens to be one of the most seasoned wealth management professionals in India with a 30-year career spanning industry-leading houses such as ABN AMRO, HSBC, and Centrum. He's currently the managing director and co-CEO of Spark Private Wealth Management, which has been growing aggressively in the Indian markets. At Trivantage Capital, we have evaluated the asset and wealth management spaces rather extensively. And our idea behind this interaction is to benefit from Ghanshyam's extensive knowledge and perspective in this space. We are enthused that this will also enlighten our investors in the process. So Ghanshyam, my friend, welcome to this webcast.
Thank you very much, Nikhil. I think the way you introduced me, I don't probably deserve much of what you say, but I hope you're able to benefit or pick up a few things during this conversation. Thank you very much for having me on this podcast.
So Ganashyam, let's begin with this discussion. Wealth management is, of course, a very interesting space for a whole lot of global investors, both institutional and family offices, etc. So my first question is, like many other segments in the Indian capital markets, is wealth management industry also necessarily a scale business, which will be dominated by just a few players? Or is there a scope of many other niche players to coexist with those large players? So just give us a perspective on this point.
Very interesting question, Nikhil, especially when you place the wealth management business in the overall context of Indian capital markets. You have the market infrastructure firms right at one end of the spectrum, significant differentiators, huge entry barriers, huge amount of reach. And therefore, those businesses will probably be in oligopoly or duopoly mode for quite some time. But let's look at wealth management, which I think the space is comparable to banks, but a lot more fragmented as compared to banks. To just look at some data, if you look at the HNI, UHNI space of the wealth market, and the numbers that are doing the rounds, household wealth in that particular segment is about US dollars 1.1 trillion. And that's growing at a rate of about 15% per annum.
Yeah.
And then you look at the last disclosed AUM number of the largest listed wealth management player in this country. You come to something like a 6% market share. So you're talking about the HNI, UHNI space, just that, and you're looking at the largest player who's probably grown the best and who is sort of growing at an aggressive pace, is at 6% market share. So you can take another data. You can look at the commission pools of mutual funds, and you can look at a long period of data about the last 10 years. Banks, which is the PSU banks, the private banks, and the foreign banks, they are at about 27%. Now, inter se, there have been changes. Foreign banks ratio has come down. The local banks has gone up. But the more interesting part is we look at large distributors, that's about 50%. And that's grown about 4% in the last 10 years. But the most interesting part is small distributors. They are at 24% and they've gone up by 10%. Over the last 10 years, the share of small distributors in the commission pie is gone up by about 10%. If you look at other pieces of data, 53 million unique MF investors, about 116 million active registered investors with NSE. Yes. This space is huge. There's also this data element that gets thrown around, what's called organized wealth or wealth that is formalized, which is coming out of the accountant and Munim sort of segment out into formal wealth, which is advice space. That's about 15%. And that number is so much lower as compared to many of the other markets. I'm told China is at about 68%. So that is the opportunity in terms of players in this segment and the scattered nature of this segment. But coming specifically to your question in terms of large formats versus niche boutique players, I think the large formats are essentially commercial banks, large investment banks with wealth arms, And the broking firms or the security firms where relationships are anchored in wealth had the opportunity of working for a very long period in a large format. The beauty about a large format is that the proposition is anyway engineered to deliver at scale, whether it be the definition of the proposition, the elements that go into the proposition, the diligence of products that go into the proposition, and the way the delivery is engineered. Reputational risk, scale, all of that are very significant considerations. And therefore, from an investor point of view, there is this huge element of solidity. But more importantly, there is a badge value in being a client of a very large wealth management firm, and that you can't wish it away. But if you look at the niche boutique players, and there are a number of them that have come up in the last 10 to 15 years, and they've carved a very significant niche for them. They are essentially offshoots of senior leadership or team members having worked in large formats. They have the solidity of working with risk compliance and process, and therefore they bring that to the table in terms of the way they have migrated client relationships. A very, very intensive understanding of client requirements, and a very solutions-oriented approach to really sort of building and growing and serving these clients. So from a client perspective, you get the benefit of solidity, but you also get the benefit of agility, responsiveness, and the entrepreneurial energy of an emerging firm. And that trend you see in law firms, you see it in advertising agencies, you see it in asset management firms, you see in investment banking firms. You yourself run a firm which is very boutique and has carved a niche for itself. And that's not unique to India. If you look at other developed markets, boutique players are growing in strength. And in the way the Indian market is growing, I think there is a place for everybody to coexist. And the growth opportunities are there. There is likely to be consolidation, at least at the upper end, where the larger players will get the benefit of being there, done that, and the network of clients will keep recommending them. But the market is huge for everybody.
Yeah, no, great answer. In fact, you referred to consolidation, and that was my, related point here, or the question on that is that do you actively see consolidation happening over the next few years? Because there may be just too many players, in the industry.
I think yes and no. Yes, because particularly the upper crust or the larger players, they are going to get the comfort of a player who has had similar sort of clients in the space that he operates in, has a very good understanding, therefore, of a broader space. Let's see a sector like IT where ESOP professionals and the way they want to sort of go about the next stage of their life, they would like to be with a firm which understands and works with professionals or works with entrepreneurs who've sort of done that. But if you look at scale, this is a business that requires a huge amount of personalization, a huge amount of customization. And as things go by, I think life journeys of customers, because they've been with RMs for a very long period of time, I think you need to be sensitive to inflection points and need to be relevant at those stages of the journey. Therefore, boutique firms have a very significant right to exist and win in that particular space. Something that the large firms may not be able to engineer at that level of intensity or that level of intimacy that boutique firms will have. So consolidation to some extent, but I have seen, especially in very significant people-oriented business, consolidation takes it to a point and it breaks down. Then there's rethink, reinvention, re-engineering. So it's like 2 steps forward, 1 step back. But the space, at the pace at which the smaller boutique firms are growing, looks like consolidation will be a gradual process. It's unlikely to be a rapid process.
Yeah, but do you think that, what's happening these days is that some of these wealth management firms are also getting listed on the exchanges, and that's why, that's where all of us as portfolio managers who invest in the listed space come in. And the more such opportunities come their way, value unlocking happens. And I think this is where maybe there's a temptation for, M&A in this space. So any comment on that?
2 thoughts on that. One is it really depends on the mindset of the entrepreneur or the stage at which the founder and team, the way their future ambitions and plans are. It is a great opportunity to monetize some part of value and see cash on the table. But the way I see firms building out, I think uh, building it out for value unlocking is, I think, interesting. But building it out from having a significant commitment to customers and having set it up and wanting to make a material difference and then grow it for a very long period of time. I
Absolutely.
think that thinking in my mind is more predominant. Also, the manner in which the seed of the idea comes and the thought comes and the way things are put together and how people get together. That from a sellout point of view or from being part of a small fish in a larger pool, I do not know how much of that really will appeal to people who are really driven by their zeal of setting up something where they can add value to stakeholders.
Got it. Great response. Ganashyam, my next question is that some of the largest wealth management firms that we see, they run a very diversified business model that includes asset management, investment banking, broking, proprietary equity research, etc. Do you think standalone wealth managers need to diversify to meet all their client needs?
Great question. If you look at the market, and therefore I think we'll have to sort of expand this conversation beyond the HNI, UHNI segment, because there are also listed players that you can evaluate in the markets that where they have a life beyond HNI, UHNI. So if you look at the mid-market and the mass affluent client segments, and the numbers are large and staggering over there, the growth is also phenomenal as people sort of go up on the standard of living and sort of look at financialization of the wealth portfolio. There you have the banks, which have a very natural reach in terms of branch presence. You have the IFAs and platforms who, with the help of technology and feet of street, are able to manage that. And you have the brokers, and who again are using technology and store presence to really penetrate that. And the growth has been stupendous. I see data where the new age brokers, just over the course of the last 5 years, in the list of NSE active clients, have reached as high a market share, 68%. And that's not a small number. The pace of client additions has been phenomenal, and that you can see across client segments in the industry. But the space of the HNI and the UHNI, you have the banks which have a natural advantage, and they have private wealth teams that but they are all trying to engineer it at scale, and that has its allure and limitations. But if you look at a few firms, at least in that space, the non-bank firms, they have harnessed it all together. I illustrate it in the way we are sort of building it out at Spark. Spark, as you know, has been around for a couple of decades, and its roots as a boutique investment bank. So has a very good understanding of working with promoters and entrepreneurs and working with capital providers and asset managers in that particular space. A very good understanding of private markets. It has also run an institutional equities business, and over the years, it had sort of got rated to rise to one of the top 3 fund manager quality of research rated firms. So a very good understanding of public markets. They harness both of this into an asset management business where across public equity, structured credit, and private equity, they've got products which are doing very well. So the wealth management business actually harnesses all of this. So it's an integrated IB asset management, wealth management business, also drawing on the strengths of equity research. So in the last 1.5 years, that's when they decided to refocus on this business and committed significant investments. The uptake has been very solid. The type of traction that we see, whether it be in terms of talent ads, which is the team has grown by 6 times in the last 1.5 years. Assets have grown by about 6 times. So the validation is there from a growth of sort of business and a market share point of view. But more importantly, I think we have now an investment banking team that is embedded in wealth management over and above the larger investment banking team there. And that serves various purposes. It works with clients on the investment banking, and many of them are senior executives in emerging companies who are emerging company entrepreneurs. So there is a conversation that is facilitated through the investment banking team. You have a large number of them that are working on as co-GPs or co-investors, for that matter, diligencing direct deals, where the team is able to add value. And there are also the large family offices that are looking for transaction advisory or the strength in placing deals before them. So all of this put together, we reached sort of a presence across 12 locations. We've gone to even smaller locations like Lucknow, Kanpur in the north, Kochi, Trivandrum in the south. But overall, when you look at the manner in which the business is scaled up, there is merit in the point that you're making, where adding all of these strengths and building it in an integrated manner allows you to capture a larger share of wallet from an overall customer mindset.
Yeah. Okay. Got it. So, as we are witnessing these days, there is a new, rage on the wealth tech side. So, do you think that these wealth tech platforms, they provide any credible threat to the, traditional business models of wealth management firms, or will these, new businesses or the wealth tech businesses prove effective only for mass retail investors? What do you think about this?
I do not think tech is a discretionary element today anymore. And this, I think, if you look at the larger ecosystem in this country and almost every area that affects daily life, I think tech has come to play a very significant part. And I think the early adopters of tech, like the wealth tech firms, at least in the broking space, I just sort of threw some numbers in terms of the way they've been able to reach out and acquire customers and become salient for customers. So they have done it and they are sort of extending it to other areas of wealth. So I think there is great hope and opportunity in that space. But it's not about traditional wealth versus wealth tech. And I sort of soon come to why. You find that even in the wealth space today, all the new age wealth creators, their ideas are built around tech. They're extremely familiar with tech. And they have expectations in terms of tech from their wealth service providers. There's a huge amount of wealth transfer that is underway globally and in India. And the next gen wealth inheritors are extremely familiar with tech and have expectations in terms of delivery of wealth services with the help of tech. And even otherwise, the choice and convenience that tech has provided in almost anything that you consume today, the wealth management business cannot be isolated and cannot keep on saying that, we will do it bespoke and the human touch and stuff, which is important. And I'll just come to that in a moment.
Yeah.
If you look at the evolution of the wealth industry, I think the first real technology, digital adoption was in the broking space, where at scale, you could deliver efficient and you could deliver solutions, which today has actually seen validation and the numbers are staggering. The next phase was delivering a client experience, whether it be digital onboarding, whether it be inter-platform integration, whether it be assisted customer journeys, if it be account aggregation. That has got embedded, and I don't think any wealth firm is immune from that.
Yes.
The third and the most exciting space is the use of AI, which really allows to deliver wealth management at scale, which includes hyper-personalization. You're able to use the processing power of machines, which can be more accurate, which can be more complex. And this is available to customers as insights, analytics, research, product recommendations, next best actions. And I think if you look at international examples, whether it be in trading, where the machine trawls data, actually predicts price movements, generates and executes trades, you may call it algo, but it's algo with a dynamic logic. And it's got embedded very well. Even you look at traditional wealth management firms doing the analytics of market information and client information, there is a fit of product recommendation. And even very, very conservative wealth management, customized financial plans being generated by AI. So now we have a beautiful combination of machine and man. Machine is all about stamina, it's about complexity, it's about processing power. There's empathy, judgment, creativity, all of that. And the ultimate differentiation is everybody will have processing power, everybody will have AI, but the differentiator will be how you're able to demystify and contextualize what the machine is saying to customers. I'll take two small examples. Based on all of that, the machine throws up a product recommendation. Okay. Then finally, for the wealth manager to understand that and understand why it said what it said, and then to look at biases and preferences and finally help in making a choice is one example. The second is the machines are going to be not only delivering information, as you sleep, they are going to be delivering insights, analytics, next best actions, recommendations. Wealth managers have to be on top of that to really make sense of that. And organizations who are investing in technology will have to also invest significantly in upskilling their R&D teams. Absolutely. To really leverage what they are investing in technology. So it's here to stay. All of us have game plans and investments. Some of us will get it right, more right. Some of it will take a little more time to get it right, but not getting it right is not an option.
Absolutely. Great, great. That was a very comprehensive response and a great one. On the other very important part, or possibly one of the most important parts of this industry, is the people. So there is a war for talent that we see in the wealth management industry, which is inflating the cost-income ratios of the wealth managers. And I could say that, in somewhat an unreasonable manner. What do you think are the factors that are leading to such a situation or such a desperation for talent in the industry? And does this mean that the clients value relationship managers to this extent that other variables such as product range, quality of research, etc., take a backseat? So is this dominating the thinking of the management teams of wealth management firms like yourselves?
Again, great question. Something that we live with day in, day out. Look at it in three parts. One is the growth in the industry and the potential of this industry is a given.
Yeah.
The second is RMs, therefore, and it's been an industry that's been largely many of the players. Therefore, as compared to asset management, the growth is an industry. The operating leverage has that much of limitation because it has to be linear in terms of growth, and that is being that logic is being turned on its head and with the help of technology. But the demand for the RM is a given, and when the demand is what it is, with the industry growing at whatever pace, those commercials and those economics, you can't wish it away. And I do not think it is unreasonable because at the end of the day, there is a dearth of quality talent in the industry, and therefore good talent, and especially if you're able to attract, train, upskill, and retain, longevity of RMs is going to be a very key determinant in the growth of this business. Now look at it in three parts in terms of why the RM. It's not RM versus that, it is all of that through the RM. No, that's the important paradigm. So in a business where at least in the HNI, UHNI space, customers are becoming more and more demanding. They are, as I said earlier, looking for enormous levels of customization, personalization, bespoke solutions. The RM, on the strength of the relationship, on the strength of the understanding, is supposed to be giving that experience and comfort, and it's very difficult to do it through something else. So that's the first thing. The second is, if you were to look at the business models of wealth and what really are the growth drivers, it ultimately comes down to net new assets. Now, you can say that we are in a wonderful environment, the markets are doing great, MTM movements will also add to portfolios, but net new assets, I think, need to be really done in a very competitive setting. And that's the difficult part, where the RM plays a very, very critical role in terms of understanding prospects, understanding clients, and then pitching the proposition. The relatively controllable part is client retention and client engagement, where I think based on client life journeys, and again, it is proven that as clients increase their comfort and vintage with an organization, the share of wallet growth is killer. When it's not linear, there are very significant jumps that you can see in terms of that. And that's what RMs work very significantly with customers in terms of growing share of wallet. And the third and the most important part, as I said, that client life journeys today are very, very different as compared to the past, where things were engineered with a certain amount of static behavior. The interventions that are needed today, and I'll just take a small example in terms of the wealth transfer phenomenon that I'm talking about. The RM is not only supposed to be sensitive to the needs and considerations of the patriarch, the old gen, but has to vibe and be extremely comfortable in creating comfort and confidence with the next gen. So therefore, in an environment where you're looking at enormous amount of uncertainty, market volatility, change of environment and stuff like that, from a handholding perspective and delivering value, right, I cannot imagine without an RM. That's number one. Second is in the competitive intensity we are in, and where there's a desperate need to be relevant and to differentiate. Sometimes the proposition becomes the RM. I know I'm making a very provocative statement,
Yes.
but in terms of an industry that is moving from product and sales driven to solutions driven,
Yeah.
and from wealth, which is core wealth, to areas adjacent to wealth, like succession planning, taxation, investment banking, family business advisory services.
Yeah.
It's very incumbent on the RM to really work with customers and actually provide organizations insights on what are the overlays they need to provide, whether it be a research overlay, whether it be a legacy planning overlay, whether it's a family business overlay, is to pull it all together. And finally, when it comes to the role of the RM, I think it is moved significantly away from my olden days when it was providing transaction support and templatized relationship maintenance.
Yes.
No longer that. He is right at the center of all of that. And finally, the icing on the cake, when technology is going to become so important, how are you going to demystify and contextualize all of that in an impersonal world?
Yeah.
So therefore, true believer that the industry is going to grow, but attracting, upskilling, training, retaining RM.
Yeah.
I'll be very, very impressed with the wealth manager who says that I'll go above the head of the RM.
But don't you think that there is this kind of a cost inflation, particularly for professional investors? We think that maybe it has been a bit excessive, and maybe because of the scarcity premium that is being paid by competing wealth managers for a very short supply of really experienced talent.
I think it's a little bit of chicken and egg situation that we are in. I always think when I look at the industry as if we are in the early stages of the industry. Well, I have been at it for almost 2 decades now.
Yes.
But the tectonic shifts and the inflection points have been significant. And there is a large manner in which there is a migration that is happening in terms of product sellers to bank RMs to mass affluent RMs, mass affluent to private bankers. So there is some sort of, not at a firm level, at an industry level, there is a career progression going on, and therefore the pool is increasing. But attracting the right talent, and if you're able to sort of create sort of opportunities across the immediate gratification of cash, both the salaries and incentives, and and that's what many of the wealth funds have successfully done to provide long-term incentives and use stock, for example, and wealth creation, for example. I think the anchoring and the hooking has been very, very good. I've seen it in my last organization where the attrition rates were as low as 2 or 3%, and the average vintage of an RM was 9 or 10 years in the 11 years that I spent over there.
Yeah.
So if you're able to do that, then it's win-win from all points of view, from the capital provider point of view, from a client point of view, and from the RM point.
Yeah. Great. Fantastic. And, finally, last but certainly not the least, do you believe that the regulatory focus will be to continuously bring down the expenses for investors? And therefore, how does this impact the margins for, wealth managers? Particularly, are there any operational efficiencies that can make up for the shortfall? So just throw some light on this.
Let me take the last 6 or 7 years, particularly from 2018. You first had the TER cap, total expense ratio cap for mutual funds. You had first the industry moving, the regulator moving commissions of mutual funds from upfront to full trail. The PMS followed full trail. AIF is almost full trail. You have direct plans very actively now in vogue, and there are significant components of various regulated product classes which are in direct plans. The advisory guidelines have got streamlined over a period of time, and there is a clear segregation of distributor and top clients between distribution and advice. And finally, the broking space, I think regulations have not only tightened year after year, and more recently, significant tightening to sort of curb investor behavior and also provide investor protection. Things have reached a steady state in my mind. I'm not able to sort of comment on whether the regulators' focus will continue to be on lowering expense ratios. And I'm only sort of guided by a recent interview that published just a couple of days ago, where I think he said 2 things, which I find very interesting. One is that all regulation will be optimum and it will be risk-based. I use a specific word saying that micromanagement will depend on this particular assessment. The second point, when a specific question to what you just talked about, he said that there is an engagement that's currently underway with all stakeholders. There is going to be time taken to put together the overall framework, and nothing is going to be rushed to. So, therefore, be that as it may, let's come to the way the industry is sort of configured. There are two types of assets that are there, which is the annual recurring revenue assets, purely because of the trail models that are doing around. And there are transaction assets and your ability to sort of monetize these transaction assets. The yields and retentions are now fairly well established across advisory, across distribution, and across fund management. And I think players have to work on two things. One is can't do much about the yields and retentions, but definitely what can be done is in terms of efficiencies and in terms of cost income ratio. As I mentioned earlier, net asset flows are going to be very important. Therefore, RM ads and distribution reach expansion, while the opportunity is available, is going to sort of provide more and more benefits to operating leverage. Well, you will argue that you're also incurring costs in the bargain, but I think it's a question of setup costs versus an operating cost over a long period of time. The second is that I talked about the opportunity for share of wallet increases, and that's now established very clearly. If you really work on a very good engagement retention model, the share of wallet numbers in terms of the additions, which is more controllable, can be fantastic. So finally, when you look at the models, bringing in some amount of manufacturing does, and keeping an open architecture system because people have committed horrendous mistakes over there, does allow you to capture a little more of the value add in the gravy train. In terms of having a comprehensive and a complete suite of products in the distribution space adds that much amount of share of wallet opportunity. Being in core wealth and areas adjacent to wealth like investment banking, legacy planning, taxation, family business advisory services, there are opportunities to sort of synergize all of that and increase engagement with clients. And finally, I think the RM productivity numbers, which are extremely critical because there is now enough and more track record that is available, where with Vintage, those numbers keep going up. And with the training and upskilling, they bring that much more to the table in terms of capturing the opportunity and harvesting the opportunity.
Yes.
So there are multiple levers, Nikhil. Meaning, I do think that whenever these big changes do come in, it's really an opportunity for the industry to rethink all of that, sort of cut out all the inefficiencies to really work on opportunity. And I think it's in a good space, despite all of the concerns that you talked about, where the opportunity for efficiencies and cost income ratio improvement is phenomenal.
Fantastic, fantastic. What a great perspective on this industry, Ganashyam. Thanks very much for your time. And I'm very confident that the viewers of this webcast will really gain significantly from hearing you. And just overall, I think thanks once again. You are one of the most seasoned wealth management professionals in India, and it was such a privilege to host you today. So,
as always, you're very kind. I can't sort of resist interjecting and saying that, it really doesn't feel justified, the stuff, the way you sort of talk about me. But thank you very much. I really had a great time. And there are many questions that it's running below the surface, but you brought it to the fore and gave me an opportunity to think aloud. So thank you very much.
Thanks very much, Ganashyam. Thanks once again.